All right, good morning, everybody. We're getting closer to FOMC, more and more articles laying out what dance that Powell has to do to kind of thread this needle. They can't just come out and cut. That would scare the markets since they had already been talking about how everything is fine and that they don't need to cut. They were expected to do some normalization cuts this year, but that wasn't supposed to be this early, and they haven't signaled that they were going to cut. So if they do it without having done those signals, it'll freak everybody out, and the markets will think they're trying to get ahead of something really bad. On the other side of that, we still have the anticipation that jobs are going to continue to get lost in the government. That's going to pile in more on the unemployment rate, and things are going to just get worse on that front, and that eventually the Fed will have to step in and cut, but not this one. So he's got to talk it up good, provide some insight, not give any specifics on levels that need to be broke before they'll act. And we'll see if they can dance that in an appropriate way. But it also ties in with NVIDIA this week. The moves that we've had in the market has mostly been sentiment driven, right? If you look at the S&P, the NASDAQ, the broader market, the effects of what we've been rolling through, it's mostly sentiment and a lot of unknowns from the tariffs. When companies have been reporting and they said, yeah, we did really good, but our forward outlook is we don't know, hope we make some money. Well, gee, not a surprise that they've gone down after that, and money has left the US to go to other nations that can provide earnings with a forward outlook that is better than that. So between NVIDIA, with its opportunity to change the narrative and boost a bullish sentiment on the AI theme and quantum and kind of wrapping it all together, and then FOMC maybe providing a little bit of stimulus and backstopping that bullish bias, we could get that run halfway back up, which is what we had been talking about for a while now, on whether or not we could make with a dead cat bounce a move at least halfway back up from this drop, right? There's really no talk of running back up to the previous highs and continuing to the upside. That's not on the table right now. It's more of a question about once we get this bounce started, and it is started, can we make it to the midpoint, 5,900? And if we get there, could we overshoot it and maybe get into like 6,000? It would be a really bullish continuation to get up at least that far. Otherwise, what would be more likely is we tangle around a 786 level. Be easier if I just flip this drawing over. This is how we would define a bear flag. There's the pull. Here's the flag. And a bear flag is supposed to continue to the downside. So if we get a failed bear flag, then we're looking to break above that 786 and begin the push back towards the midpoint. Well, we got the break above and we closed above. That's a good start, but we need to keep it. So fading back down below 57, getting back inside and closing within this 786 range begins to make us think that we don't have a failed flag after all, that we just have a wider flag, because flags don't have to stay within that 786. They can be a little wider down here. So we're looking for that sentiment boost with a combination of NVIDIA this week and all of its constituents that are participating, or customers and clients that are participating, and FOMC together to give this a boost. We also have an auction today, one of the big ones. I know we're not supposed to have favorites and treat them all the same, but we do tend to see more of a reaction when we look at, say, the 30-year and the 20-year and the 10-year. So those are ones that I like to pay attention to. But anytime we have an auction, you want to pay particular attention to that. We're going to be seeing a rate decision out of Japan tonight. Not really expecting too much of a surprise. Just like with our own rate decision, the decision is basically already out there. It's the forward outlook and whether or not they can talk it the right way without putting their foot in their mouth. So we'll see. And they've gone through so many prime ministers lately that this new guy, he's just that. He's new. And we know mistakes happen when you've got somebody new out there. They can say the wrong thing, get taken out of context, get misquoted. So just want to proceed with caution right now. Looking at the smaller economic events we have on the table today, we don't really have large outlier numbers like we did yesterday. These were some significant differences between the forecast and the previous numbers. So they caused a little concern. These numbers are really a lot closer together. So it doesn't mean that we can't see some impact from these. If the numbers miss by a significant value, that can get our attention. But it's more likely that these are just going to be smaller waves, and that the bigger focus is on FOMC and the keynote address that we're going to see from NVIDIA today. But that NVIDIA event is going all week. There's also been some headline news of a significant change in the way that EVs get recharged, or how fast they can be recharged. That was hitting the news this morning. It's affecting Tesla, and what's that other one? They quoted Baidu, but I don't think it was that one. Could see Baidu plus 3.8 on Tesla headlines. But I think it was that BDY EV company out of China talking about recharging a car as fast as you could put gas in a regular car. So 5 to 8 minutes, right, for an average person to pump gas in their car. That is a fast recharge. That might cause some problems today too. Rethinking the U.S. sanctions regime. If they flesh that out the way they normally do, which is by just throwing things out there and seeing how people react to it, rather than, calmly considering what they want to say and putting together a package and releasing it, this could cause some market moves today. The call wall and the put wall were moved yesterday. The put wall was rolled up, which is considered a bullish behavior, and the call wall was rolled down, which is considered a bearish behavior. You could consider that those two kind of cancel each other out. With OPEX on the table, we know there's going to be positioning, and we know that those tools on Spot Gamma can just automatically flag a level that may only last for like a day or two. In the Spot Gamma report, when it does that, they usually say something like, yeah, that's the current level, but we consider it a false wall, or, they'll give in the note, they'll offer a different level, and they'll offer their insight on if they think that this is a temporary or a short-term call wall or put wall. I didn't have the AM notes before I started. I can see that they're out now. Once I get them shared, you'll want to go through and see if they mention anything about a false wall or a better wall than these two, implying that maybe one of these isn't going to last for very long, that it doesn't stick. Otherwise, we are at the 10-day moving average. We tried to jump above it yesterday and we rejected, fell back down. We're trying to run at it again today. It's this blue line right here, 57.39. We also have the 3-week moving average, which we also cut above last night or yesterday. We rejected, came back in, and then we hit it in the pre-market here. So that white line. If we can get above those, we have the volatility trigger 57.55. Then we have a voodoo line 57.86. 20-period moving average 58.32 cog line. Those two overlap. And then zero gamma right before we got the 10-week moving average. A lot of resistance to the upside we have to work through. As I mentioned yesterday, you're going to see market maker moves all week. Even if they are in their hedging, we wouldn't know it because we can't trust the market maker move this week. Because it's OPEX, we're going to see that all week, even if they're not hedging. So we can't tell if they're hedging additionally or not. We have to assume they would on FOMC, but for these smaller events that we're getting, no idea, because it's just not going to be useful. I know in a perfect world we wouldn't have that problem, but the fact that we have it at any other week other than OPEX, it's still a really great tool, and nothing works all the time anyways. We're slightly down this morning at 0.25%. If we do want to get to one edge or the other, that implies we're closer to the lower edge than we are the upper edge. And we can get to the lower edge easier because we don't need to break out of yesterday's price action to do it. So from that point of view, it's more likely that we get to the lower edge than it is that we get to the upper edge. But as we mentioned yesterday, when it comes to an FOMC week, while we expect to go sideways into the event, there's been weeks where we start Monday with a run and we just continue to do it all week, or at least for Monday and Tuesday, right, into the event. So with that in mind, I would focus on something like yesterday's levels. We got yesterday's high and yesterday's low, all of it, not just the RTH. And that provides us with this half back around 5,700. We want to keep that if we want to continue to hold the highs and maybe even continue to go higher today. I think if we get below this half, then it's going to be a line in the sand that we have to get back above, and it may be a bit tricky to do that into FOMC. Keep in mind that if we do break that low, this half, and we get back inside of Friday's range, that would be another level that lines up really close to that 5,700 that would make it difficult to come back above, right? So it's kind of two lines of support there, or three. You got the half back, 5,700 as a round number, Friday's high. If that doesn't hold and we break that back down inside of it, it's likely we stay underneath it into FOMC. Now, can we wick down there and then come back up? Sure, yeah. I don't think that would be too big of a problem. But I think if we get below it and close below it, say on a 15-minute time frame, we would need some news or catalyst to bring us back above it. I don't think price on its own would be able to get back above it without that catalyst. Today's central pivot is higher than yesterday's. That's bullish. Price opened above that channel, and that's also bullish. We've come down and we've hit that channel, so we don't have an MDP. This has us set up really nice to hold the line and continue from here. Even the lower edge of that channel lining up around 57.05 lined up with the measured move that we were just looking at around 57.05. That's another level of support that we're looking at. Just another line that we can add, another pivot that we can say, and it's a half back, and it's the channel edge, and it's the 5,700, and it lines up with Friday's high. It is a wider channel, which implies that if we do break out, the breakout doesn't stick and we come back in again. Keep in mind that these channels don't make price do anything. They just give us insight on what to expect if we do get a breakout. Yesterday, we had a wide channel and we broke out and it struggled to get that breakout. It actually came back down and came back in. Then we got some news that really gave it some juice and we ran on up and continued to run. So the wide channel told us that we weren't likely to break out and run, and that held until news just really kicked us into gear and we took off anyways. But these channels don't make us do anything. On the week, we do have a very narrow channel, which implies that we could get a weekly breakout that could continue to stick and that we could expand outside of last week's range. It's not much of a surprise because last week was a really tight range. We didn't get much done looking at Tuesday, Wednesday, and Thursday. But to get outside of the entire week's range, we'd actually have to get all the way up to that 5,800 because that was Monday's overnight high from Sunday into Monday. So if we're looking for an inside week breakout, we've got to get all the way up there and then break out of that and then continue to run, which is what that 5632 cog line weekly pivot point suggests we could do. Not before FOMC, of course. $5,800 has a point of control from 2 weeks ago. 5650 has a point of control from last week. In between those two, we had a really shallow area that it now seems we're building out around this 57, maybe 57 and a quarter. It's pretty narrow range. All things considered, it was thin on the run up. Then we put in a lot of work yesterday. That's where our point of control is. 5711 cog line on the week. So better representation of that shallow area. we can move through shallow areas relatively quick, and we don't leave much of a footprint behind. So in this situation where we ran up and we got stuck and we hit something, the longer we stay here, we can start to distribute and build out a price shelf like we did back here. It's where our point of control is now. It's where all that mess is that's underneath us. But the point of control is underneath us. And all of this stuff that's over our head is going to continue to degrade because we're going to take more candles off the left side over the next few days. So it will disappear as we continue to run towards it. But once we're back in that area, we're going to be leaving new footprints behind. $56.50 is a good line in the sand for longer term swing trades as a level that we don't want to see the market get below at this point. Now that we've come back above it, we've started to build structure beyond it. We don't want to go back down and revisit it. We certainly don't want to close below it on a daily time frame. We have a new VPOC that we got from yesterday. Since we're dealing with a new contract, we'll just start using a new color. That way we can distinguish these new ones from the older ones. $57.50, yesterday's point of control. You can see how we ran up yesterday into the high of the day, and we put more volume in up there than we did through this entire run down here. So we moved that point of control from 57.06 up to that 57.50 in the later part of yesterday's trading. Now it's a level that we've got to get through, and since we haven't hit it yet, it's a VPOC. Not a lot of insight on today's profile yet. All right, looking at the 10-day moving average, we're back within its gravity. We could hover 0.5% or even 0.75% above and below, just chopping about back and forth here. This is healthy. It gives the market time to regroup, get some strength, build up some energy before another move. If we were to turn on something like the RSI Laguerre, we would probably see that this move up exhausted it and that it would be looking to chop here to build out energy for another move. If you're not used to that kind of phrase, energy in trading, normally we'd use momentum, trend, inertia, but that indicator, the RSI Laguerre, it really changed things. Think about this analogy is the best way to describe it. If you take a ball and you go out in the yard and you throw that ball, well, you put energy into it, you threw it, and as that energy dissipates, the ball slows, it falls, it hits the ground. That's common sense. Take a ball to the top of a tall building and throw it off. And as that ball falls, it's picking up energy. The more it falls, the faster it moves, the more energy it gets. So we can't always say that something that's moving is, burning energy. It can actually be picking energy up during the move. So using that indicator, we learned a lot about how markets get energy, what kind of market behaviors to look for to see, is it moving now with energy behind it, or is it moving now and building energy up, and how much energy does it have so that when it does begin to break out again, we're looking at it with the perspective of this is a breakout with no energy, or this is a breakout with a lot of energy. We want to see how price reacts around this 10. As long as we're at the 10, we can cross back and forth through that level. It won't be support or resistance. It'll just be a zone that we expect to hold around until we finally leave. We'll be looking for a 1% move above or below to finally escape that orbit and get away from it and begin to expand beyond it. We're still 3% away from the 10-day moving average. So, the base case argument would be that we're going to go back to the 10-week because we were so far away from it that we're almost due to go back to it. While that's true, eventually we will go back to the 10. That's a guaranteed. We will eventually. The argument becomes at what point, how soon are we going to make that move? Because FOMC or NVIDIA or both could sour sentiment even more, along with any new headlines on tariffs or the war. There was headlines yesterday that the ceasefire in Israel is off the table and that they're back at it. At any moment, Russia and Ukraine could start going at it again. It wouldn't take much sentiment, coupled with tariffs, a faux pas by NVIDIA, FOMC, Powell putting his foot in his mouth, that we could expand again to the downside without making it back to the 10-week at all. If nothing breaks, then the base case argument is we go back to the 10-week. And just like the 10-day, we would expect to get there, hold around it, begin to digest, and look for a healing process, a correction through time. We didn't get much done yesterday. If you think about other FOMC weeks where we were green and we continued to push, we've seen other weeks where we got a Monday that went to the edge by the end of the day. We didn't get to the edge, and we gave half of yesterday back if you think about how this candle closed. Not quite half, but pretty close. If you take a candle with a bullish sentiment or just a sentiment of a gauge, like 4 quarters, we can put a 75 line on here, and we could put a 25 line on here, and then we would have a four quarter candle. If we close in the upper 75%, it's a really bullish candle, pretty obvious. If we close in the lower part, it's really bearish. Again, pretty obvious. But if we close within the middle here, we don't have that bullish and bearish bias so strongly. Closing too close to the middle to have that continuation. But another part of candle logic suggests that the body is where all the trading took place and the wicks are where all the stops got triggered. I like to think of that, sure, but also consider defense. If we ran up into a bunch of people that are just sitting here waiting to sell it, they got some selling done, but we don't know if they're done selling yet. Once we triggered that selling, we fell out of that zone. We won't know if we're done until we go back up there and see if there's more selling that gets triggered. So they're defending 5,700. There's lots of selling happening at that level. We don't know if they're done yet. If we can get a break out of yesterday's high, then we've got this gap to close at 57.26. That'd be a really good line to focus on. The 310 candle open is what we hit yesterday before we started to fall. We need to get above that open and get this gap closed. And this isn't even the real gap, right? The real gap is all the way up here because that's where we closed and this is where we opened. So that's the gap that needs to be closed. But let's focus on this lower one first. That'll be the close of the Friday, March 7 candle. The open, I mean. To close it, we got to get to the close of Friday. I know that's not how all analysts do it. That's how I do it. As for that capital rotation, this is a change over the last 5 days. And as you can see, all the sectors are at least green, even if just barely green, like consumer discretionary. All of them except Staples. Now, Staples got hit pretty hard with Walmart, Costco, BJ's, all those guys. And then some more of the more specialty retail, they were getting hit pretty good too. So, yeah, it's still down a bit, but it is trying to turn around. It's got the same shape as a lot of these others. So when we're measuring growth versus value, right, like we were talking yesterday, it's not the idea that growth is going up and value isn't. But if we're looking at growth versus value and growth is leading, then growth is outperforming value. And that makes sense looking at it from this angle, that it's performing like these others. It just hasn't moved as far and it hasn't moved as fast, but it is moving in the same direction as all these guys. Unfortunately, it's hitting the 50. That's not too concerning because, well, the 50 is basically sideways with the 200. Sideways moving averages don't have a lot of merit. Not really interested in them when they're sideways. So keep your eye on Staples, see if it can continue the drive. It's got a gap to close down here. Looks like 81.5. The concern is that we'll get there, get rejected, and begin to fade back down and lose Staples. Kind of want this capital rotation to lift all boats at this point. We kind of need it. Bitcoin is down. The Mag 7 group and consumer discretionary. Not going to get a rally day if we don't have the Mag 7. Unless after the open we get some options flow coming in. And we can't tell that in the pre-market, so it doesn't do us any good. But looking at things from the pre-market, we can't rally if we don't have the Mag 7, we don't have chips, consumer discretionary, Bitcoin. Looking at what's up this morning, we got gold. Gold miners, a little bit of China, and energy. Generically speaking, energy, right? Not specifically like solar or coal, nat gas, just XLE, which is really generic for energy. And we got oil and gas exploration moving in the right direction. It's just not up enough. So gold miners continue to do really well. Precious metals, they've been doing good, which they usually do good into FOMC anyways, oddly enough. So if we're going to get a run today, keep your eye on the Mag 7 and or look for that options flow in the indexes to come in. The GTC conference from NVIDIA has like 85 to 90% of the NASDAQ 100 participating in the event. So if they start to juice things up, the sentiment turns bullish, we should see collectively the advanced decline on the NASDAQ 100 begin to turn heavily bullish too. That can do it. So gold miners, pot stocks, silver, uranium, all to the upside. And on the downside, the heavy hitter that really needs to change, Bitcoin. Airlines and solar, that's not going to hold us back. It's not really a concern. Consumer discretionary and Bitcoin, those two need to turn around and start going to the upside. And if we look at this, it's just an algo print at this point. It might even be hard to see on the screen. It's all the way down here at 195.80. And those algo prints, just like we had one way down here yesterday, we opened up here. And sure, we faded down. We got that gap closed from where the algo print was offered. And then we ran up afterwards. So we could open, back up here above 197, fade down into 195, close that gap, run back up again. I wouldn't count it out just because of that little algo print. We need yields up, bonds down if we're going to get this rally. So seeing bonds fade like this, it's helpful. It's a good start. We need to get that breakout outside of yesterday's range and continue the drive to the downside. So get below 90. We can see all these wicks down here, but there's buyers willing to step in when we get below 90 and run us back up. Still, bonds falling is a good start, because if bonds are falling, yields are rising. All right, guys, watch the clock. Keep your eye on the headlines. Don't forget the auction at 1 o'clock today. It's a big one. Be careful. Be safe. I'll see y'all tomorrow.